For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir Technologies has been a favorite among retail investors for quite some time, often drawing in momentum traders looking to ride its waves of volatility. However, the company's stock has recently experienced a significant decline, causing many of its most dedicated investors to reconsider their positions. According to new information from Vanda Research, retail investor purchases of Palantir stock have dropped dramatically since the beginning of February. This is a stark contrast to mid-January, when retail interest in the stock surged as traders sought to capitalize on its momentum. At that time, Palantir was one of the most actively purchased stocks among retail investors, reflecting strong confidence in its future prospects. However, that enthusiasm has cooled considerably. Palantir's stock price reached a record high in February, marking a peak in its recent rally. Since then, the stock has plunged by 32%, significantly underperforming broader market indices. The rapid decline has raised concerns that the stock may be losing its retail-driven momentum, which has been a key factor in its previous rallies. Marco Iacchini, a senior vice president at Vanda Research, weighed in on the situation, suggesting that Palantir is among the most vulnerable stocks in the retail trading space. He noted that if there were a single stock at the greatest risk of a sharp reversal, Palantir would be at the top of the list. This statement underscores the uncertainty surrounding the stock and the potential for further declines if retail investors continue to exit their positions. A deeper analysis of the factors contributing to Palantir's sell-off reveals multiple concerns that may have dampened investor sentiment. One of the most notable developments is the recent disclosure that the company's co-founder and chief executive officer Alex Karp has established a structured trading arrangement to sell a substantial number of shares. Specifically, Karp has initiated a plan to sell up to 9,975,000 shares of Class A common stock over a defined period. This trading arrangement will remain in effect until September 12th of 2025. Such structured trading plans allow company insiders to systematically sell shares over time, typically to avoid allegations of insider trading. However, the timing of this announcement has led to speculation that Karp may believe Palantir's stock is overvalued, especially given its extraordinary rally over the past year. In that time, the stock has surged by an impressive 248%, far outpacing most other technology companies. The announcement of Karp's trading plan sent a strong signal to bullish investors, many of whom interpreted it as a lack of confidence in the company's current valuation. Adding to the concerns, other Palantir insiders have also been aggressively selling shares, according to data from Yahoo Finance. Insider selling is often viewed as a bearish signal, particularly when multiple high-ranking executives offload significant portions of their holdings within a short time frame. While insider sales do not always indicate trouble ahead, they can contribute to negative sentiment, especially among retail investors who closely track executive actions. Meanwhile, Palantir is facing potential headwinds from the broader macroeconomic and political landscape. A recent report from CNN revealed that newly appointed Defense Secretary Pete Hegseth has implemented an annual reduction of 8% in defense spending for the next 5 years. This policy shift could have significant implications for Palantir, as the company heavily depends on government contracts to generate revenue. Much of Palantir's recent stock surge was fueled by expectations that the Trump administration would substantially increase defense spending, potentially leading to more government contracts for the company. However, with this unexpected shift in defense policy, investors are now reassessing Palantir's long-term growth prospects. If government spending in defense declines, Palantir may face challenges in maintaining its revenue growth, forcing the company to rely more heavily on commercial contracts. In addition to these external factors, Palantir has also raised internal concerns in its latest annual report, which was released on the same day as Karp's stock trading plan announcement. Among the key issues highlighted in the report is the company's sluggish hiring rate. According to Jefferies technology analyst Brent Thill, Palantir's workforce grew by only 5% in 2024. This follows a 3% decline in 2023, signaling that the company is not expanding its operations as aggressively as some investors had hoped. Over the past 2 years, Palantir has added only 98 employees, which is a relatively modest number for a company seeking to solidify its position in the artificial intelligence and big data analytics sectors. Beyond hiring concerns, Palantir is also experiencing notable executive turnover. On February 12th, the company's chief accounting officer announced her resignation, with her departure set to take effect on February 24th. In response, Palantir's chief financial officer, David Glazer, has assumed her responsibilities on an interim basis. Executive departures can sometimes raise red flags among investors, as they may signal internal challenges or strategic disagreements within the company's leadership team. Another pressing issue for Palantir is its high level of dependency on a small number of key clients. The company's top 3 customers accounted for 17% of its total revenue in 2024, reflecting a concentration risk that could become problematic if any of these clients decide to reduce their spending. A more diversified revenue base would provide greater financial stability, but Palantir's current reliance on a handful of major clients means that any changes in their spending patterns could significantly impact the company's overall performance. Brent Thill provided further insights into the broader market environment, noting that the last time a stock experienced such extreme valuation expansion was during the pandemic-driven tech rally. During that period, several high-growth technology firms, including Snowflake, CrowdStrike, and Datadog, benefited from elevated market enthusiasm, leading to inflated valuations. However, the macroeconomic environment has since normalized, and investors are becoming more cautious. As a result, Thill cautioned that any combination of negative factors, such as slowing revenue growth, fluctuating interest rates, fading excitement around artificial intelligence, or continued insider stock sales, could put additional downward pressure on Palantir's valuation. Given these risks, Thill has assigned an underperform rating to Palantir's stock, indicating that he expects it to lag behind the broader market in the near term. In summary, Palantir's recent stock decline can be attributed to multiple factors, including a significant reduction in retail investor activity, insider selling by key executives, potential headwinds from lower government defense spending, concerns over slow hiring and executive turnover, and an over-reliance on a small group of major clients. These challenges have raised doubts about the company's ability to sustain its high valuation, leading some analysts to adopt a more cautious outlook. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.